Oil just crossed $110 a barrel. War is breaking out in the Middle East. Global capital is scrambling for safety. And right in the middle of all this, Goldman Sachs is telling clients to buy China. Yeah, not gold, not the US dollar, China. So what are they seeing that everyone else is missing? When conflict hits the Middle East, the entire world starts worrying about oil, because most economies are still heavily dependent on it. But China, it's already starting to move away from that system. Less than 30% of its energy comes from oil and gas, and nearly half now comes from renewables: wind, solar, nuclear. Think about the difference. Most countries are still stuck filling up at expensive gas stations. China is building its own power system at home. And on top of that, it has over 3 months of strategic reserves. So when oil prices spike, China doesn't get hit the same way. Now here's where it gets interesting. For most countries, higher oil prices are just bad news. Inflation goes up, costs rise, growth slows down. But for China, this might actually flip the story. Goldman expects rising energy prices to finally end a 41-month stretch of producer price deflation. That's more than 3 years of factories being stuck in a constant price squeeze. Now, they might finally get some breathing room. Higher prices mean better margins. Better margins mean stronger profits. And that feeds directly into the stock market. At the same time, global markets right now are moving almost in sync. Fed policy shifts, geopolitics, risk sentiment. Everything is connected. But China is a bit different. Its stock market has a very low correlation with the US, around 0.2, which basically means when the US market moves, China doesn't have to follow. Foreign ownership is still very low. Valuations are already compressed. So adding China into a portfolio isn't just about chasing returns. It's about reducing risk. That's also why Goldman is still calling this a slow bull market. And when things get uncertain like this, there's one thing that starts to matter more than anything else. Cash flow. Not stories. Not hype. Actual cash. That's why Goldman is highlighting high dividend stocks in China. There's a policy push right now for companies to return more cash to shareholders. So what you end up with is pretty simple. Low valuations, plus consistent payouts. In a volatile world, that combination becomes very powerful. But the most overlooked part of this whole story might actually be AI. This conflict is showing something deeper. AI is no longer just about tech companies. It's becoming part of infrastructure, part of industry, part of national capability. And in that context, China's position starts to look very different. Because it's not just building models. It's applying AI in power systems, manufacturing, industrial automation. This is what some people call physical AI. Not just software but real-world deployment at scale. So when you put all of this together, the picture starts to change. Yes, global risks are real. Yes, oil shocks matter. But China may be one of the few major economies that can absorb that shock and keep moving forward. Lower dependence on oil, relatively independent markets, stable cash returns, and a growing AI industrial base. And maybe that's the real shift here. In a world where energy is becoming a weapon, the biggest advantage might be not needing it as much. And that's why, while everyone is looking for safety, some of the smartest money is quietly looking at China.